Okay, good morning, everybody. Welcome to the Daily Energy Markets podcast. It is Thursday, November the 2nd. I'm delighted to have joining us today Yiyong He, founder and CEO of LNG Easy, Matthew Wright, senior freight analyst at Kepler, and Saleh Yilmaz, senior energy equity analyst at Bloomberg Intelligence. Thanks so much, gentlemen, for joining us today. We just had those headlines in front of us there, and the survey question result from yesterday, which showed that economic sort of headlines or sentiment would be what would be influencing oil prices going forward, rather than this escalating conflict in the Middle East, which doesn't seem to be having too much of an impact yet, at least. Saleh, let me go to you first and ask you about that. We've had a few conversations the last week about the risk geopolitical premium on prices, how it went up, and now it's kind of settled back down. What's your outlook for that? I mean, do you think that we're going to be heading down, if you like, towards the 85 or back up if things remain the same geopolitically?
Yeah, I think that makes sense. That result isn't too much of a surprise for me. The oil market seems to have shrugged off that geopolitical risk premium that we saw in the first couple of weeks following the conflict. And the attention does seem to be shifting more towards this bleak and not very strong demand outlook that seems to be present in the market. I think for now, the market seems to think that the conflict will be contained in the Levant region. No risk yet. I mean, there is risk, but no impact yet on any oil production from the wider region. And I think it seems to think there is a smaller risk of escalation. So, but then on the demand side, again, there's a lot of uncertainty. We are seeing a lot of mixed data in US consumption and then with China manufacturing, and it seems to be changing day by day. But then I think in terms of pricing, I think we will continue to be range bound between current levels and perhaps low $90 a barrel kind of levels. We know that we still have the defensive and aggressive OPEC Plus stance with the output cuts. They've shown time and time in the last year or so that they will continue to protect a price floor. If demand proves to be even weaker than initially expected, they will just bring more cuts. And then that's really protecting the downside, I think. And in terms of the upside, I mean, until we see some real signs of demand rebound, demand recovery, I think that's going to continue to be an overhang. So we continue to see prices remaining range bound without a significant demand rebound. And of course, on the supply side, without any escalation of the conflict in this region.
Okay, thanks, Saleh. Matthew, just to go to you on that, we have one of the bulletin headlines says Standard Chartered $98 oil is well supported by fundamentals. That kind of seems to be going against the current sort of sentiment of plentiful supply, plentiful extra supply, if needed, next year from OPEC Plus and non-OPEC, and of course the weakening demand scenario going forward. Are they just talking their own book, or do you see that you know, we could, they're saying supported by fundamentals, not by geopolitical risk premium. What do you think leads them to do that?
Yeah, good morning. I would disagree. I think there has been a tightening in the last month, but I think that is now going to give way. And we're seeing crude dropping down into the low 80s, potentially even to 79, 80 over the next 6 months. Our outlook at the moment is that Saudi is going to extend the cuts beyond May until the end of 2024, because they're going to see that the current price level is not supportive of their finances. So I couldn't say if they're talking their own book or not, but they're maybe not looking at the full macroeconomic picture. I also agree. I don't think the current geopolitical crisis is going to be the main determinant driving prices. Now, if there isn't, with these black swan events, you just need one thing to happen and all bets are off. But you know, I agree with Salih that unless that happens, we're going to see a continued sort of build in the supply side, which is going to, you know, weigh on crude prices. We're not seeing a big collapse, but there's more downside than upside.
Okay, thanks, Matthew. Yi-Yong, welcome. Let's talk a bit about gas. Oil is getting all the attention these days because obviously the Russia story has sort of settled, if you like, into a new normal of, okay, Europe's now accustomed to what's happened with the gas situation there. But let's talk a bit about Asia and gas. Winter's coming. Asia is always very nervous about what Europe's doing with its gas intake, obviously, because that impacts it. What's the sentiment there for LNG?
Thank you. I would just say maybe I would talk separately LNG away from gas, because pipeline gas is one market. LNG is another market.
But Europe's been taking in more LNG because of its problems with pipeline gas, obviously.
Yeah.
And that has impacted Asia last year, at least.
Yes,
Yeah.
and European storage is full now, almost 100% full. I would say, you know, the demand in Asia is there is demand for LNG. For example, you know, Vietnam has bought one cargo in July, but they had not bought the second one. And then, you know, the Philippines have put in 2 FSRUs in place. However, I think, you know, the elevated prices had, you know, kind of weakened demand, to be honest, because when you had LNG to power, you know, the competition is coal and renewable, right? So, you know, so Thailand is buying a lot of LNG because they don't really have the fuel switching abilities. But other countries, I would say, you know, if prices are more reasonable, then we see much more demand than today. It's
Okay.
a bit elevated, the price levels.
Do you think that because everyone else is commenting that, I mean, relative, I suppose, to where they got to last year, they're not attractive, you're saying, but
no, because I mean, obviously last year we had LNG price at 80, I think $86 per MMBTU at the peak. So that's kind of very high. But you know, if you look at the LNG forward curve today, spot price at, let's say, $16 is about 20%, and then we had a slightly going up, you know, to 20, you know, set between 20 to 25%. So LNG is more expensive than oil, but you know, we all know that the heat value parity is 16%. So it means LNG is more expensive than oil, and why don't you use oil? You know, or coal, even much cheaper, right? So that's yeah, relatively speaking, has come down, but you know, not vice versa crude oil prices.
Okay, thank you, Young. Saleh, let's talk a little bit about supply again. We have a headline there on US oil output hitting record as producers boost drilling efficiency. Of course, we've had some news over the last couple of weeks of M&A activity in the US shale patch sector, you know, getting more consolidated there. And so therefore, you know, supposedly getting stronger because you've got stronger players in charge, right? Who are going to do what they like as well, despite what OPEC's telling the US in that sense. So Saleh, give us an outlook for that. I mean, only a few months ago, people were sort of saying US stable, it's not going to go back to 13 million barrels a day. Forget that. That's not the new area of supply. Were we wrong?
Yeah, so I mean, we actually shared that concern, if you will, because we know that a lot of the US shale players have shifted their focus from kind of increasing output at all costs to being more kind of shareholder return friendly, giving back to shareholders, which meant, I mean, this obviously was coming at the expense of higher capital spending. So we knew that we were not going to see, despite the much higher, much more elevated pricing environment, we knew we were not going to see these companies just investing away all their profits back into the business. So that's why perhaps, I think a lot of analysts are surprised to the upside on how well, how quickly the US oil production is going up. And I think as you as it's written in one of the headlines, I mean, this is partly being driven by efficiencies. But still, I mean, there is significant additional marginal barrels coming from the US this year. It is very, I mean, of course, it is going against what OPEC Plus is trying to do, but you have to remember this region is very kind of price elastic, and they can kind of respond to price a lot more quickly. It's short cycle. And in terms of M&A, I think that what we saw with Exxon and Chevron and the consolidation in the shale patch, it really seems to be aligning the portfolios of both majors. It gives them a lot more acreage. And I think for both of I mean, especially for Chevron, it gives them the exposure to Guyana, which, I mean, is important to note, is one of the significant non-OPEC production areas that's growing very, very fast and is going to be one of the important regions to watch. So with these companies kind of becoming part of the majors, which are obviously integrated, a much bigger part of the whole oil space, you could say that they will be looking at potential new projects a lot more closely as the new unit.
Okay, thanks for that. Matt, let's talk a bit about Russian oil. You know, it's been a pattern a bit. You know, we had this India equation where it took in the first half of the year, increased volumes, increasingly more and more, of course, taking advantage of the discount. Now that's dwindled a bit. Again, we have a story on it today on the bulletin, but that, you know, for a couple of months, then they kind of slowed that intake down. And now we're apparently taking more Saudi oil again. Sort of balancing that out because of price, obviously. Any sort of thoughts on that in terms of market impact? More of the same? Do the Saudis care?
Yeah, really interesting development. So obviously, you know, India has been a massive supporter of the Russian crude market, taking vast majority of their crude since February 2022, ramping up to way beyond people's previous expectations on even how much they could handle. And this comes down to the fact that they've got some of the most modern and sophisticated refineries that can essentially alter their crude slate quite dramatically and still produce on spec all the different products that they require. India's gone through maintenance. We had monsoon season towards the end of the summer, early autumn. So they reduced a lot of that intake. And the expectation from us was they would ramp that back up again. I still think that you know, it's still too early to tell how much Russian crude is they're going to take. But it is interesting that we have seen this slight uptick in Saudi crude. From a tankers market perspective, this is very significant because part of the strength in tanker markets over the last 18 months has come down to the fact that the dislocations in crude and refined products flows from Russia, and India and China and the flows to those countries has been a massive part of that. We're now at post-peak Russia effect in that sense, in that we're not seeing any more ton miles being generated on those routes. If anything, you know, this development is a reduction in that, because obviously the voyage from Saudi to India is far shorter than the Baltic or the Black Sea. So from a tankers market perspective, this is a negative. Even for the owners who are not engaged in any Russian trade, they benefit vicariously from the overall tightness in the market. But as I said, I think it's still a bit early to say that they are going to sort of continue to reduce Russian barrels, that they are still getting a discount. And should that discount widen again, they will definitely increase their volumes.
And does this pricing from Russia have anything to do with its production capacity or rates, if you like?
To an extent, although I think the discount narrowed quite significantly over the summer, and it's essentially been low for close to 6 months now, and they were continuing to take it. So I don't think it's necessarily just to do with the discount, because the discount had already dropped quite a lot prior to refinery maintenance. So there's probably some other factors there.
Okay, thanks, Matt. Yi-Young, let's talk a little bit about gas again, but more about let's take your view on long-term supply. we've had some nervousness around, certain producers such as Australia having issues with LNG. We've had new contracts signed with Qatar recently, again with a few European players. So where do you see that sort of dominance and pattern carrying on in terms of future secure suppliers of LNG and those who may be retreating from that?
I think the Total, I think, make an estimate based on confirmed projects, FID taken. We will have a compound annual rate of growth of 5.2% or something like that from now till 2030. I think that's a lot higher than crude. I mean, if you like, so some analysts are putting crude picking next year, for example. So I think, we had a lot more LNG coming relative to other, liquid cargoes. So I'm not so worried about, lack of supply and so on. I think the focus should be now to switch to demand generation.
Which generation, sorry?
Demand generation.
Demand generation, okay.
Yeah.
And how do we do that? How do we generate demand?
Well, so basically, for some countries, wealthy countries like Japan, Korea, Singapore, and so on, Taiwan, we, use LNG as a primary energy source, to make power, or some are doing refinery runs. So primary energy. But I think, when it comes to primary energy, developing countries are cost conscious. I think, people talk about a 10 cent per US dollar per kilowatt hour, a benchmark. So not that many countries can afford more than 10 cents, and which at the current pricing environment, LNG cannot do. So I think the most important demand generation would be in the retail fuel sector, where we can use LNG as a secondary fuel, to compete with LPG, heavy fuel oil, diesel, CNG, and so on. So that's where we see a lot of demand in Asian countries.
So shipping, does that include shipping?
Obviously, shipping, LNG bunkering is part of retail, it's a retail game, yeah.
Okay, thank you. Saleh, let's talk a bit about products. Gasoline, gas oil, diesel. We've seen a lot of diesel support in the third quarter in general because of shortage of supply, maybe rather than demand. But and the gasoline season obviously is over in the US, etc. But what's the trajectory for the rest of the fourth quarter, do you think, in terms of the not swaps, what the cracks?
Yeah.
that's the word I'm looking for. On that,
yeah. I mean, you're absolutely right. In terms of crack spreads across the barrel, but especially middle distillates, it's been a pretty strong quarter. I mean, from the company side, from the equity side, from some of the integrateds and refiners that I cover, we are now going through their earnings season where they're telling us about their third quarter. And we are seeing a significant recovery, a significant uptick in the refining margin that actually surprised us quite a bit, because we did have that slump in the second quarter. We knew the third quarter was going to be better, but I think they've gotten significant support, especially from diesel, as you said. So I think from some of the commentary that we heard from some of these companies, they seem to be expecting fourth quarter not to be as strong as third quarter, but still very healthy levels that could potentially kind of continue into early 2024. So as you said, I think that's partly demand, perhaps surprising to the upside, but especially I think it's about refinery maintenance, some unplanned shutdowns. So it's really on the supply side that's I think giving a lot of support for a lot of these products.
Okay, thanks. And Matt, talking about refineries in Middle East, we've got a lot of new, a significant amount of new capacity, coming online already, and again, in the next few months. How is that indicating how trade patterns may change yet even more than we've seen already because of other factors?
Yeah, they're going to have a huge effect. So just focusing on, say, take Northwest Europe. So Northwest Europe is short diesel. That's going to be an incredibly important source of diesel. However, a lot of those refiners are not capable of producing Northwest Europe winter spec diesel. So it's not a solution year round. And that's one of the issues that we're sort of heading into in Europe this winter. Previously Europe would take Russian diesel, which does meet, the cold properties required. We're having to look, Northwest Europe is having to look elsewhere. And this is part of the reason why we have these high diesel cracks at the moment, is finding that alternative source of supply is difficult because you can't just turn to the Middle East. The US is a good solution, but, there's other there's other areas that demand that product as well. You could get some of it from Northeast China, but we're seeing potential issues around crude export refined products export quota availability. So there's going to limit that. So the Middle East is definitely going to be an important component, and it's going to see some of the less efficient refiners sort of pushed out of business over the coming years. Again, I'm always sort of going to turn back to what it means for tankers, but from a products tankers point of view, we're going to see more ton miles because we've got more sources of supply away from the sources of demand. So the crude ton miles are going to decline because the crude is staying within that region, and the product ton miles should rise because we're going to be seeing more products shipped around the world, probably on larger vessels as well.
Okay, thanks. Yi-Young, just back to you on some. I mean, LNG Easy, as I understand it, also deals with the conversation around carbon offsets, etc. And I just wanted to talk to you a bit about that. I mean, this is more of a sort of thematic question, but we've got the COP28 meeting coming up here in less than a month's time in the UAE. Of course, many things on the agenda there, but if we focus in on what's going to be asked of the energy sector, that is one of the sort of tools that's been offered as needs progression. Give us your sort of impression on whether we're going to make any progress in terms of sort of global cooperation on that.
Thank you. Very good question, and my favorite question. In fact.
Okay. I didn't know. Okay.
So I think the people lumped fossil fuel in one basket, oil and gas, and then what we can do to abate emission from oil and gas. I look at things differently. Basically, if you look at the United States, the past 15 years, the biggest contributor for the greenhouse gas reduction has been coal to gas conversion. So that's billions of tons. We are not talking about millions of tons. We're talking about billions of tons. So if you add all the different elements together, different technologies together, 10 of them add together is lesser than coal to gas conversion. For example, Tesla, I think the fleet of Tesla worldwide reduces like 10 million tons. That's one steel mill for you. All the EVs together under Tesla. So basically, the question for the world is, we had a solution which can really reduce emission by billions of tons, but how do we make LNG as cheap and as widely available as gas? Because don't forget, United States is home to $2-3 per MMBTU gas. So if you go to Bangladesh, they're buying at $16, $17. That's 5 times too much. And then how do you expect them to go away from coal into LNG, right? So I think collectively, if the world can say that there's enough production capacity for LNG, and there's enough feedstock gas in the ground, how do you get it to the customer and make it affordable to these giant developing countries with hundreds of millions of population? That is the issue that COP, the new COP meeting can address very well.
Yeah, and hopefully they will. I mean, this whole focus of COP last time was, I think one of the things that they concluded with in their statement was, we must recommit to helping developing countries afford energy and sort of finance the energy transition, etc., and other solutions. There's our survey question for today. and Matt referred to what he thinks is going to happen earlier on. OPEC Plus will definitely extend cuts into 2024. I mean, that's both, I suppose. The question is addressing the group cuts and the voluntary cuts as interest rates finally, start to impact oil demand, and therefore obviously, impact the price and require more OPEC support. Saleh, let me go to you on that. So we'll put that to our audience and see if everyone agrees that they're going to definitely have to extend these cuts, because demand is finally going to definitely kick in. We're going to see that reflect in US economy, in Europe even more. Europe's not doing too well anyway, but this lag impact of interest rates, Saleh, is beginning to bite. We're probably going to see it in fourth quarter results in certain companies. Again, sentiment on demand, weaker demand will finally come to fruition in 2024, won't it? It didn't this year.
Yeah, so I did vote yes. I wasn't sure about the definitely, but our thinking currently is that with demand being so uncertain, if this continues to the end of the year, I think they will be not forced, but I think it will be nudged. They will be motivated to extend this at least for a couple more months. And how we talked about, and I agree completely with Matt, that the geopolitical risk premium that we saw seems to have been gone completely. But I think another scenario is that actually there is still a little bit of geopolitical risk premium, but it's being overshadowed by significant demand pressure. So if there wasn't this geopolitical uncertainty, maybe we would already be down at $80 a barrel, just because demand just continues to be very not as strong as we thought. Again, I mean, I don't want to call it weak, because I don't think demand is necessarily weak per se, but it is surprising to the downside. So yeah, I think our current thinking right now is that this uncertainty in demand going all the way to the end of the year will probably be motivating the group, including Saudi Arabia's voluntary cuts, to be extended into the first quarter of next year.
Okay. Matt, I mean, we didn't mention China specifically, but let's talk about demand there, at least in terms of what you're seeing as projections for next year. A lot of commentary this year on, it's disappointed economically, growth was only 3%, not even 5%, or that's what's being called for by the end of the year. But others saying, no, China's ticking along quite nicely. It's still going to be giving the markets, enough support in this new normal. Has there been any updated sentiment on the shipping front or on the demand front indicators for you there as we go into next year?
Yeah, absolutely. China's been a really interesting one this year, because from an economic side, it looked incredibly gloomy, and yet crude imports continue to remain very, very high. So there's a bit of a contradiction there. I think there is definitely a risk. I think, there's some people there was some analysts come out and say that the property sector concerns is now at its peak and it's not going to get any worse. I do think the concerns around China have been overstated to an extent, because when it comes to China, it's very easy to be shocked from what the incredible growth we've seen in the past. I don't think it's as bad as potentially it's been stated, but there are definitely concerns. I think we are, we're going to continue to see similar levels of crude imports over sort of the remainder of this year and into next year. But I think one of their main issues is around the fact that their quotas, particularly for crude imports and refined products exports, are just so choppy. They're running short of crude import quotas at the moment, so they're turning to fuel oil, and diesel and gasoline inventories are building quite rapidly, and we are running out of their third batch of export quotas. So there's a big concern around that, around whether they're going to, and that's almost going to be the bigger impact on what their crude imports do.
Yeah, and also, I mean, of course, there's a price sensitivity angle, which is, oh gosh, I don't like that result. That looks like software. That's like my camera's just mucked up. I think that's okay. All right. Well, we are convinced that OPEC is going to extend, of course, short of any other developments. Yeah, thanks, Matt. That's interesting. And also on as you said, on the product export quota side, they've backed off a bit there. And you said crude imports have been good, but of course, when prices went up a little bit a few weeks ago, or in the last couple of months, that has lessened, but probably because their inventories were full. But it'll be interesting to see what they do actually if prices do sort of calm down a bit more towards that 80 level. Thanks so much, everyone, for joining us. We've just hit 11 o'clock. Matt Wright, Yiyong He, and Sarah Yilmaz. Thanks so much for joining us, everyone, and have a great week, remainder of the week. Thank you. Bye-bye.
Take care.
Bye-bye.